afternoon and welcome. As you know by now, Unlock the Stock is a platform that is specifically designed for retail investors to gain access to corporate management and to get to know the management team and their companies just a bit better. This episode of Unlock the Stock is sponsored by Easy Equities, the platform that helps you grow and protect your wealth, where you can invest in local and international shares, property, unit trusts, crypto, bonds, and actively managed ETFs. Plus, you can get access to Easy Protect life insurance and Easy Credit lending to back this financial journey. We are very pleased to welcome today for the first time to Unlock the Stock, Homechoice International. Sean Wibberley, the CEO of HIL, Weaver Fintech and Finchoice, as well as Chris DeWitt, the CEO of Homechoice, will join us today and take us through the presentation shortly. Unlock the Stock is not possible without our technology partner, Lumi Global. You can visit their website at lumiglobal.com to learn more about their various online AGM and investor presentations. Our hosts today, a bit later on, will be the finance ghost and Mark Tobin of Coffee Microcaps, who will lead the Q&A session. But before we start, there are just a few housekeeping notes. Sean and Chris will take you through a presentation that will be followed by a Q&A session. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on our Unlock the Stock YouTube channel soon. There are another 40-odd videos on that channel that you can definitely go and take a look at as well. You will also see an email address when we start the Q&A session. And if you would like to be added to Homechoice International's distribution list, please send an email to that address. Stephen, I'm ready for you to share the presentation, and then I'm going to hand over to Sean and Chris to take us through the presentation, please. There we go. Thanks. Over to you guys.
Thank you very much, Vanessa. And thank you to the finance ghost and Mark as well for hosting. And good afternoon, everybody. Chris is the CEO of the Homechoice retail business, and I'm the CEO of the group and the Weaver Fintech vertical. I'm going to take you through a deck. It very much echoes the slides I've been sharing with the market the last 2 days. If you want more detail on our stock, please go to homechoiceinternational.com and you can get a lot more detail on our business. Can I go to the next slide, please? Thanks, Stephen. Just broadly, to give you the structure of our business, HIL is the listed share on the JSE, and it comprises 2 distinct verticals. There's Weaver Fintech, the fintech ecosystem, and then the retail business, Homechoice. Homechoice was the founding business. We're celebrating our 40th birthday. Founded in 85, and then Weaver Fintech has 2 brands that are customer facing within it. The Finchoice brand, which we launched 18 years ago, and the acquired buy now, pay later business PayJustNow, which we acquired in 2021. Thank you, Stephen. A brief history on the business. So we're celebrating our 40th birthday in the Homechoice group. The business was traditionally a homewares direct marketing business. That's how it was configured back in the day, mail order. And over time, that business progressed to being a catalog retailer, then a catalog supplemented with a call center. And then I started the business of Finchoice in 2007. I joined the group in 2006 and launched the Finchoice business. I co-founded it in 2007. And we then moved out into showrooms. So not just being at a distance, but having a showroom where customers can come and touch and feel the retail product. That was launched in 2015. We, subsequent to that, in 2016, launched an insurance vertical within the financial services business of Finchoice. We acquired PayJustNow in 21. And in 24, 25, and going forward, it's all about scaling the Weaver ecosystem and the retail business getting onto a strong growth trajectory. Just some interesting stats. The Weaver business could fill 20 Cape Town stadiums with the number of active customers we have. We've got over 7 million bedrooms that have been bought by customers, so to speak, or looks in their room. And so over 7 million customers are sleeping under Homechoice bedding. You might notice Chris in the background wearing the Royal Garden Peach jacket, which is our top seller. We've sold 140,000 of these designs to customers over the years, and it's become somewhat of an icon in our business to wear that jacket. Could I go to the next slide, please? Who is our customer? We very much talk about her when we talk about our customer, because over 70% of our customers are female. This stems from the fact that our customers are home proud females who are buying homewares through the Homechoice channel, and also because the PayJustNow business is very much a retail payments business, and retail tend to be dominated by females. We've also noticed over time, females tend to perform better from a creditworthiness perspective. And just traditionally, this entire business has had a her focus when it comes to how we create products and who we think of in our minds when we're discussing product design, UX, and pricing, and the whole merchandising product range. We've got 3.1 million customers now that grew 50% over the year, and driven very strongly by the high growth in the fintech business, which I'll cover a bit later. So she is a black urban female, about 37 years of age. Over 70% of customers are female, and she's earning about 16,500 Rand a month. Thank you. Looking at the group numbers very, very quickly. So revenue up very nicely, 20% to 4.4 billion, and the PBT up 31% to 517. So very pleased with our numbers and the 5-year trend of those numbers. Most of our transactions in the business tend to be concluded digitally. That's been a big drive. We were traditionally a catalog retailer, then a telephonic retailer / lender. We then moved into a lot more digital, and going forward, it's going to be digital on steroids with AI. Our headline earnings up to 393.9 cents, up nicely 27%. You can see the mix split in profits between the Weaver business on the left and the Homechoice business on the right, where Weaver continues to dominate the profit share at about 92%. And we see Weaver's growth continuing very strongly, albeit that Homechoice is also growing very nicely. And those ratios may well play out a bit further into the future. Thank you. I won't re-echo the revenue numbers. Operating profit up 32%. Our group customer numbers, I'll echo that again, 3.1 million, really strong growth of getting numbers of customers into our portfolio. And another interesting stat is we're a relatively short-term credit provider when it comes to the retail business and the lending business. So our books are very high yielding. And last year we collected over 1 billion Rand on average per month from our customers across the different product sets that we have. So we generate a lot of cash out of our portfolios. Thank you very much. Next slide, please. I'll now do a deeper dive into the Weaver fintech vertical, and then later Chris will take you through the retail vertical. Next slide, please. The key model to impart to all of you on our business is this concept of a two-sided ecosystem. We have 2.7 million customers in Weaver Fintech, or consumers, and we have over 2,800 merchants or brands across South Africa. And that 2,800 merchants translates to about 10,000 points of presence. That's because some retailers have multiple stores. Cape Union Mart would be a great example, Game, Macro, etc. And then there's some big online merchants like Superbalist, who would be single points of presence, but obviously with very high volume coming from such a large retailer in the market. And it's two-sided, so we've got a number of products all digitally integrated across the PayJustNow and the FinChoice platforms. Consumers are attracted into the portfolio by one of our products. At the moment, the hero product is by far and away the buy now, pay later product from PayJustNow, and I'll give you some more color on that in a later slide. customers come into the ecosystem on one product, and then we digitally serve up personalized offers to that customer in an attempt to get customers to cross-sell into our other product suites. So we have lending products, we have insurance products, we have payment products, and then we have search and discover type products where customers can come into our portfolio on the PayJustNow real estate and search for goods or product types and search for merchants, and then drill into those merchants' websites and actually do the transaction live online. So a whole range of virtuous products linking consumers and merchants in our ecosystem. Thank you. And the chief reason for doing this is if you look at the revenue we earn from the average customer, when she has one product, we earn about 1,000 Rand, a little over 1,000 Rand. That's a graph on the top right. And the second product that jumps to over 8,000. And this is because she tends to be taking a higher margin lending product or an insurance product. And the cost of acquisition of that customer is very low because it's done digitally. So very, very efficient business in terms of that second and third and fourth sale. Our credit is also better each time because we've got more data on the customer to make more informed credit decisions, more informed limit management decisions. And of course, because the platform is digital and by design engaging and 24/7, there's a lot of engagement and repeat business and stickiness on the platform. So this sort of virtuous trilogy, so to speak, drives the velocity with which customers take second products or repeat business on the same product. And it's efficient, so it drives our bottom line and our margins. About 20% of our portfolio now of active portfolio has consumers with at least 2 products. We have a longer term vision of that being 50%. Due to the very, very high growth right now of our acquisition, we are naturally having a high proportion with only one product because they've just entered the ecosystem. But over time, we see these consumers naturally self-selecting other products that we will personalize to that consumer using our data, using our machine learning models to serve up the next best offer to that consumer. Thank you. And the AI for us is clearly the next wave, and this is no secret to anyone. If I think about the history of the business, the FinChoice business, if I'm talking about financial services, we spent the first few years of our business exclusively as a telephonic lender. So at a distance, we would be phoned or phone consumers to conclude a credit transaction or a sale of a loan or a repeat loan. And then in the last 10 years, we've been digitizing massively. And now about 99% of loan transactions are done digitally. The next wave will be taking our data, our digital platforms, the fact that we have consumers on smartphones already engaging with us digitally, and then using AI to really leverage the efficiencies and the personalization that AI can do so well. What you see on the slide is already we're seeing operational efficiencies using AI. Our engineers use it to help co-pilot them while they're coding. It helps with testing. It helps with the rigor of the code because the served up code from the co-pilot is in the right format and what have you. And so it's efficient from a business process point of view. Our customer experience, we're using propensity models and next best product type models, which again, it anticipates what the customer is looking to get. And our models also make sure that what we offer, she could afford, knowing what we know about the consumer. That's fantastic from a CX point of view, and I see this getting better and better. And then data-driven insights, so around credit especially. So using lots of different touch points within our ecosystem to make sure that we can analyze fraud, we can make the right decision with credit. It's all done in real time, tons of different decisions, and it gives us the ability to offer the right product at the right price at the right time to the right consumer. And AI, of course, makes this, accelerates this. Right now, our efficiencies per employee, we've gone up to about, it's just over 5 million Rand per year per employee in revenue generated, and that's up from 2.5 million or 2 million 5 years ago. So the efficiency of the business are really scaling through the use of analytics and AI tech. Thank you. Our customers, last year, in the Weaver FinTech business, we grew customers by over 100,000 per month. So we booked 1.2 million customers. We have an active book of 2.7 million customers, chiefly, as I've said, driven by the viral word of mouth buy now, pay later product. And I'll touch on that product a bit later. And then we assess how our customers feel about us on the platforms. So our Google rating for FinChoice and Page is now very strong at 4.6 stars and 4.7. So, we're very proud of how the customers are seeing us. Our philosophy has always been over this last several years to be her favorite. We know that we're not her only provider of financial services, but we do want her to feel like we're her favorite. And that's an emotional connection with her and our brands. Thank you. So it's a great slide in terms of the last 5 years of trajectory of the Weaver business. We've had CAGRs on these major lines of over 30%. One of our strategies on the top right is growing our fee income percentage. So clearly we earn income from credit, but we also earn income from fees such as insurance and merchant commissions on our payment network. That's steadily going up, and it's great to see it sort of jumping actually in the last year to 36%. And we have a longer term goal of that being closer to 50%, which would make us even more cash generative. And ending the year, with a CAGR of 36% on our PBT at 561 million for 2024. Thank you. A bit of detail on the P&L. I won't spend much time on it. Revenue up 34%, driven by all of our lines, the lending lines, as well as the insurance and the buy now, pay later payments business. Our write-offs were higher than revenue, 37% up versus 34% on revenue. And we had some challenges at the beginning of last year in the implementation of a new dialer platform. So that we had 2 or 3 months of those teething problems are behind us, but it did give us a bit of a knock. And at the back end of 2023, we booked a pocket of business that translated into write-offs in the early part of 2024. But one interesting thing with this business is very short term. And so in terms of our lending, so when we do book a bad patch of business, we're able to write it off and right-size the business quite quickly by focusing on our existing customers and shaping the book towards better risk customers. One of the key elements of the ecosystem is its cost efficiency. So our cost to income ratio dropped to 25%. That's down 1.1 percentage points. And again, this is evidence of us scaling our fintech platform. 5 million revenue per customer, per employee, as I mentioned earlier, up very nicely, 35%. Thank you. Key to our philosophy of being her favorite is that she can access her credit from her phone. Our loans grew 31% last year, a strong drive in the second half of last year to our existing customers. I'm very pleased with the result of that, of where we've got to on the growth. On the right-hand side, our Mobi Money product, which is our credit-backed wallet, continues to grow in how customers are engaging with that short-term product. And, we did 1.1 million transactions last year. We also launched the ability for customers to scan a QR code at over 600,000 points of presence in South Africa in order to access the credit in that wallet and do a retail transaction. And that grew nicely, and I see that whole category of payments growing nicely for our base going forward. Thank you. We have a smallish market share in the South African unsecured lending market. The purple graph on the top left shows the percentage of unsecured lending that we do relative to other lenders in the market as reported at the National Credit Regulator. And we've grown that nicely to 6.5%. So it's up 44% on this time on Q3 a year before. The reporting is slightly lagged. And we've taken this market share and seen the growth we have whilst remaining a top quartile performer, as evidenced by comparing our performance at the Credit Bureau with a basket of the top banks and the top lenders in South Africa. So this top quartile is the percentage of one's book that is in an up-to-date position, and we remain in the top quartile. Our credit metrics, so debtors cost as a percentage of the average book, relatively flat around about 20%. We're a short-term lender, as I said previously. On the bottom right, you can see the mixed distribution of the tenure of our loans. And what this means is, I mean, our longest loan is 36 months, and all of our acquisition is only done on the 3-month or the 6 or 12-month loan. So if we book a bad patch of external business, for example, a new business, it does write off relatively quickly, and we're able to pivot the business. Lenders with much longer unsecured loans, have to live with those long loans and deal with them in the collections department, whereas we tend to have the ability to shape the book quickly and get the write-off off our portfolio fast. Thank you very much. Next slide. Insurance, one of the verticals within the financial services business, that grew to 182 million in gross written premium. This is collected premium from customers on our funeral and personal accident product. A key thing is we are grooming the customers more and more to take insurance themselves digitally from their smartphones. Insurance is typically a push-based product. No one jumps up in the morning wanting funeral policy, for example, but it is very necessary in this economy, and there is demand for it. And it's trusting our platform digitally that's so important to us. And I'm very pleased to see that we've gone from 20% to 41% in the last couple of years. Our newly scaling personal accident product seeing really strong growth off of where it was in 2023. And we're only 16% penetrated in our active base with our policies, and we believe we can get that up much higher. Thank you. On the payment side, so very much we want our customers to operate in a cashless environment and to be with her at the moment of truth when it comes to checking out a basket of goods, be it online or in store. So the buy now, pay later business, this is the pay in 3 business on the left-hand side. We acquired the PayJustNow business in 2021. And what this product enables customers to do is in real time, at over 2,800 merchants, they can check out and only pay 1/3 of the asking price from the merchant, and then another third a month later on their payday, and then another third a month after that on their next payday. So what this means, the consumer doesn't pay anything for the splitting. It literally is divide by 3 and pay a third, a third, a third. The merchant pays a commission to us for enabling the sale. And merchants like this because they're seeing a higher basket size, they're seeing better conversion through their sales funnels. And clearly consumers like it because it's making things more affordable and it's splitting the purchase over time. We also launched a wallet. So when customers refund purchases made on buy now, pay later, it goes into the wallet. And we also enable the ability to top up that wallet further with a loan from the FinChoice business. And then consumers can go and shop using the balance of that wallet at PayJustNow merchants. At the back end of last year in Q4, we launched our product, which we branded PayStretch. This allows customers at the same PayJustNow points of sale to split their payments over 12 months. But this comes at a fee to them in terms of interest and fees, and allows clearly consumers to buy larger ticket items and spread the cost over 12 months. And we'll look to enhance this product with longer tenures and more flexibility at the till. So consumers can buy in 3, they can pay from their wallet, or they can pay in 12. Thank you. The buy now, pay later business, very viral, booking 100,000 a month, and more of those new customers are becoming repeat customers. And we're seeing the jaws on the top right opening between now 2/3 of our sales are to repeat BNPL customers. And that we expect those jaws to open over time as more and more customers adopt and increase their frequency and their basket sizes over time. PayStretch will add to this. It's another payments vehicle in their stable, and I'm very excited about how that's going to scale into this new retail credit market in South Africa. Next slide, please. Merchants, merchants are getting the higher basket. They're getting customers check through their conversion easier, but they're also getting customers coming back and repurchasing from them, which is very important for merchants. And we can see cohorts of first-time buy now, pay later customers in the following years are buying substantially more as they grow in their frequency, their basket size, and their familiarity with the smart way to pay. We cover many household brands, large and small retailers across South Africa. Last year, we exhibited over 300 million in touch points to customers, showcasing merchant offerings via email or customers seeing deals on their real estate, and a very good conversion of 8% into leads then driving back to the merchants. So this virtuous circle of more consumers eyeballing merchant offers, going back to merchants and then making their purchases, making the merchants have a higher appeal for the product, meaning that more merchants join our network, which makes it more appealing for our consumers. It's a very virtuous two-sided network that we have here. Next slide, please. Chris, I'm going to hand over to you now on the retail section.
Thanks, Shona. We can flip across. Right, so as Sean said, we started about 40 years ago as a catalog business, and for the last 3 years, we've been in a turnaround after COVID. So when I started, the business made a loss, and I'm very proud to say that we've kind of come out of our turnaround now, and we've set up the platform for some real exciting growth over the next 2-3 years. So, just some history. We had to make some changes on credit, and we had to pivot the business away from the traditional supported South African post office and telephone infrastructure. And we are now going after significant growth in showrooms, and I'll explain the showroom concept. So in terms of our overall income statement, you'll see at the bottom 50 million profit before tax, about an 80% growth year on year, and all our ratios well in track, setting up a real good platform for growth. You can go to the next slide, please. All right, so our sales growth is really driven by mass market. We have the best blankets in South Africa, and our growth really in the second half of the year underpinned by a showroom strategy. So rolling out showrooms, taking the product to the customer, and growing our new customers. So about 15,000 new customers a month, and our showroom mix last year 18%, this year 26%, really driving that kind of growth. And then we've rebuilt our customer base over the last few years with really strong credit underpinning that. In terms of the next slide, in terms of our showrooms, it's really unique in South Africa. We don't carry any physical stock in the showroom, so it's more an unlimited browsing engagement. You've got the opportunity to engage with the product and feel the product. And also we allow the customer to immerse in this shopping experience, so touch and feel, and then combine digital elements with the physical experience. And these new showrooms, we are going after locations where there's high footfall. It's where our customer lives. It's on their kind of travel arrangements every day. And also the showroom is not only a sales engine, but it's also a place where a customer can make a payment. About 30% of our parcels are collected in a showroom, and it's really a high engagement format, which we are extremely excited about. Very convenient for her. Next slide, please. So in terms of our growth, so the last year about 50% up in this channel in showrooms. We would like to get to 100 showrooms by 2027, and we see some real proper runway here. The unique size for us, or the optimal size, is about 250 square meters. Our trading densities are 4 times higher than our older, larger format stores, and competes very well with other retailers that actually has physical stock in their stores. And then our payback on these new showrooms, it's less than 2 years. So it's really a strategy that started to work for us, and we're excited about expanding this. Next slide, please. Just in terms of her digital engagement and convenience, so we are all about convenience. So if it's convenience where you would like to shop, so in a showroom, we give you the convenience to shop online, we give you the convenience to shop in a catalog, and now we've also introduced the convenience to buy on WhatsApp. So we've seen some large engagement, firstly on service, and we're also now starting to roll out that you can buy your products on WhatsApp. Digital transformation has been important for us, and you'll see there the number of sales per agent. We've increased that by 43% in the last year, and also the collections per agent, nearly 40%. That's with digital transformation, investing in technology. Social commerce, this is where we are pioneering, and we want to, from social commerce engagement, we want to translate that into a sale or a service element and be there for the customer, again, around convenience. And then lastly, our Homechoice app, we see that there's more engagement, but also more sessions through some of the push notifications. We're really trying to transform our experience through multiple digital channels, but also combining the digital experience with the physical. So when you walk into our showrooms, lovely showrooms, digitally you'll be able to see the product. When we walk in, we help the customer so that they can service, they can get their balance, they can pay. You get your confirmation of your order, and everything's in one place for her convenience. So we're really excited about the future. We are excited where we are, and we are poised for some really exciting growth over the next 2-3 years. I think those are my retail slides. Sean, maybe I'll hand back to you now.
Thank you, Chris. Can I go to the last slide, please? One more slide. Thank you. There we go. As Chris said, very excited with the trajectory in retail and the trajectory in Weaver itself. The ecosystem is growing at well over 30%, and it's done that consistently for the last 5 years. And we see that the momentum is very strong, and we still have relatively small market shares across our different financial services lines. And I see this really getting momentum. Cross-sell in the ecosystem is, we do that now to 20% of our customers. I see that being able to grow to 50%. And that is just really efficient, powerful business for an ecosystem. The more you can cross-sell, the more valuable and sticky the ecosystem is, the more you attract more customers and more merchants. We will continue in innovating and investing in technology and the people to support that tech. Our new innovation called PayStretch has taken off nicely. We spent a long time curating the product, and we launched it in Q4, and I'm really excited about our plans for the next couple of years on that product. And retail doing tremendous work with the showrooms. It's an extraordinary experience for our customers to, for the first time in 40 years, being able to go and touch products and engage with them. And then they work on the digital chat platforms. Our year to date, we've been trading since the start of the new 25 year, January and February. And I'm very pleased with where we are. We're in line with where management expects our targets to be, and the momentum is continuing into the new year. Thank you for your time, and thank you for hearing Chris and I talk about our story.
Thank you so much, Sean and Chris. So everyone who's on the call, you've seen Chris's beautiful, vivacious jacket, and Sean mentioned it, Royal Garden Peach, and we're told that bedding remains the best seller in Homechoice, and that this design is also being applied on some fun and funky products like the formal blazer, Converse style tackies, socks, and even a sofa. So on that note, I'm going to hand you guys over to the finance ghost and Mark Tobin to take you through the Q&A.
Thank you, Vanessa. Thanks to everyone attending. Sean, Chris, welcome to Unlock the Stock. It's very good to have you guys. Those jackets are fantastic because it makes it really easy to know where to send each question. If it's retail, it's Chris. If it's fintech, it's Sean. If you can't figure that out from the jackets, then I have almost no hope for you. I should disclose up front, I'm not currently a shareholder. I think there's a very good chance I'll be a shareholder by the end of today. I was kind of using this as my final little DD on what you guys are up to. And I must say it all looks very impressive. So I might ask harder questions than normal just because it's my money on the line here. Not just the money of those who are attending who will have their own questions in the DMs. So make sure you send those questions through in the DMs. I think where I'd like to start is maybe just slightly high level, just to help people absolutely understand the economics of how that buy now, pay later works. And I promise I've got lots of questions for you, Chris. So let's start with Sean. Just from a merchant perspective, how does it work when they sell using PayJustNow, for example, or a credit card? What is the difference to them? And then what is the difference to the person actually buying the product?
Okay, so from the merchant side, if a customer were to do a transaction using their credit card or their debit card for that matter, there's an interchange or commission that the merchant would pay to the acquiring bank for that transaction. It's a few percent. With the buy now pay later product, it's exactly the same concept. Obviously, it's a larger percentage because the buy now pay later product needs to have within it not just the card interchange, but also the cost of funds, because the funds are deferred over a couple more payment periods. And then, of course, there is some bad debt that some customers don't pay. It's less than 2%, but that needs to be factored into the cost. So the merchant pays a higher commission for effecting the sale than they would a normal debit card or credit card. But the value add to the merchant is consumers are able to buy up, as in buy the more expensive sneakers, for example, or buy a larger basket of goods. And they also are able to convert through the sales funnel better. So if you think about your credit card, you've got to enter the details and do a one-time PIN with the bank and so on. Once you've already established that with PayJustNow, you can go shopping at a retailer and just enter your PayJustNow details to get through the transaction. And so from the consumer side, online, you just choose PayJustNow as a payment method. And in store, you would scan a QR code at the merchant point of sale and affect the transaction using your PayJustNow app. And what happens is you get debited 1/3 at the point of sale, and then 1/3 a month later, and 1/3 a month later by the PayJustNow system.
Yeah, I actually tried it out myself. I'll hand over to Mark now, but I remember trying out PayJustNow. I tried a BNPL transaction a few months ago. I did one at a merchant, and then kind of all your details are set up. Then I tried to do a couple more, and then eventually it said, no, thank you. We don't know who you are. That's quite enough for now. Let's make sure we collect our money from you before you carry on with this. So nice pass mark there on the on the credit management.
Yeah, we tend to, across the group, do what you would call a low and grow approach. You start with a lower amount of credit, and often you can't make multiple transactions at the same time to see that the consumer's learning how to service their obligations, and then we would extend your credit over time as the customer gets familiar with the product and has proven their ability to handle the credit.
Thanks, Sean. I've got a couple of questions here. I'll just take them one at a time, maybe. First question revolves around Weaver's major competitors. I mean, we've had Lasaka on here. The question mentions them, Capital Appreciation have got their layup product. Altron FinTech, obviously, we haven't had them, but they're also in this kind of space. So maybe talk to, are those guys, for say Lasaka, for example, are they enablers or are they competitors, or maybe just sketch out the landscape of who else you're competing against and who maybe are more partners than competitors.
So if we talk about the payments sector, and then I'll talk about lending as a separate competitive set. So in payments, we have a couple of buy now, pay later competitors that we compete against. So PayFlex is one, HappyPay is another one. And yeah, well, I think we compete strongly against them, that the market is still nascent and growing. And the concept of buy now, pay later is still growing in the consumer marketplace. And I think once consumers use it, they're very viral in sharing it with their friends, and the concept of it. So yes, we do have competitors, but I'm convinced that we have a very strong moat and an approach and a brand that consumers are engaging with. On the lending side, frankly, all of the lenders that are registered with the National Credit Act are our competitors. So all the major banks would offer lending products that could compete against ourselves. And then we have the non-bank lenders, the large players such as RCS, Direct Access, and what have you, who compete against us. But we've been competing against those players since we launched the business 18 years ago. The credit market is vibrant, and I believe our competitive difference is the personalized digital access with which we can engage and reassure our consumers. We only offer products to consumers that we believe from our data she can afford and have been pre-approved. So the experience and the reassurance we offer, I think, is very compelling.
It's a very good question here in the DMs that I want to pick up nice and early. And I appreciate such blunt questions. Anyone who reads Ghost Mail knows that I prefer to just get to the point. So let's get to the point on this one, which is on the finance side. And in terms of how you fund the book, Sean, how are you? So the question is quite beautifully worded to say, how do you not pull off an African bank? Which I think is just very well worded, actually, which is to say, how do you not get into that hole? You're giving out loans, you're funding it. Obviously, lots went wrong there. But yeah, from your perspective, how you fund the book, etc., I think people are curious about that.
So I'll try and answer it in a number of different ways. So we have a consortium of lenders, and they are very much backing our business model. One of the key lenders has been with us as long as I've been in the business and knows us backwards and is very supportive of our model. When we, in our last line of funding or capital raise, we were 60% oversubscribed in terms of the debt financing offered to us. So, I believe our track record of credit management and our growth and how we collect the debt and the cash flows that we get in from our very high yielding books is evidenced by that support. And going back to the African bank story, so they had very long-term loans. We have a very highly engaged customer who will take short-term lending and do so at multiple points over the course of a year. So we believe we're very close to our customers. The book is shorter term, so hence you yield more collections per the average size of the book than you do if it's a much longer term book. And we've got the support of our lenders. And during COVID, which is a great example of the sort of power of our book, is that in Q2 of when lockdown happened, if you'll all recall that in March back in 2020, we proactively tightened our lending. We stopped all lending to brand new consumers, and we slowed down our lending to existing customers. We didn't turn it off. So I do believe you need to keep your customers liquid. But we radically reduced our limits. And we pulled 400 million rand very quickly back into our group coffers in the unknownness of the lockdown. And that was a very powerful thing to do. And now, if you recall from my slides, we are collecting R1 billion a month from our customers across the group. So if we slowed down our lending, we would shore up our cash reserves very, very quickly if there were ever to be a squeeze on our capital. But I don't anticipate that there will be in the near term, because our bankers are very supportive. We're looking at the future about what other notes programs could we do to augment our capital structures and what have you, and are very proactive about that with our ALCO as to getting the right lines of funding for the future.
Sean, another question here, more on the financials. And the question is, there's a divergence between cash flow generation and profit generation. So I think that's like EBITDA turning into cash flow on the other statement. Maybe just talk to us, is that down to timing on lending, or is it just the way the like working capital cycle happens on the retail side of the business?
Chris, have you got a good answer for that?
Yeah, so I think if you look from a group point of view, there's a lot of investment into the Weaver business, and all the capital is going in there to grow those books. And if you look at the CAGR, 30% plus over the last few years. So, most of the working capital goes in there. And then on the retail side, as we have been starting to rebuild the business, it's consuming a bit more working capital. So I think for the next, 2 to 3 years, you'll definitely see that we probably consume more cash and funding to invest in these books that are highly profitable, but also, returning really good returns. And, Sean's mentioned, the last 5 to 10 years, his credit risk has stayed relatively stable. It's within a very narrow band, and that's the way that we kind of, manage the capital in the business.
If I can bring in another one, Sean, maybe just to address this on the buy now, pay later collections. There's 2 questions here on, do you get involved in payroll deductions? And I know, we've had lots of court cases in the media about that. And, just maybe clarify, you're involved in that, not involved in that. It's in terms of collecting those 3 monthly payments.
So the collections, the way we collect money from consumers that use the buy now, pay later product is to tokenize the collection at the point of sale. 1/3 is taken off using the normal credit card rails. And then we tokenize the next 2 installments to happen on the pay date of that consumer. So it's convenient. It's on your actual salary credit day that we get the funds. And it's done based on her net salary into her account. There's no payroll deduction or anything like that. It's money she has in her account post her expenses that we then collect on her salary date.
Perfect.
From my side, I wanted to ask from a capital allocation perspective. I mean, you're sitting there with quite an old retail business that has this strong position in its market in South Africa. It's very interesting. You've got this now radical growth fintech side, which is obviously super exciting. I think it's really putting Homechoice into the spotlight to some extent. The capital allocation balance can't be easy because you're also opening new stores, etc. But then you need to make sure you're funding the book, for example. I'm just curious, firstly, how you think about that capital allocation over time. And then secondly, linked to a question in my DMs, how do you see the sort of competitive environment in your retail business playing out? And how does that affect your capital allocation decision? Because of, for example, the sort of Chinese drop shippers that have become such a big competitive force in this market. It's sort of just understanding how you see that world.
All right, Sean, shall I take a go at that?
Yeah.
You're okay? All right. So, if you look at the capital allocation and the significant growth over the last 2 years, where a lot of the bank funding has gone into, it's been in Weaver. And, Weaver's return is superior than the retail business because we were in a turnaround. So, definitely the last 2-3 years, all the capital allocation for growth and funding went into Weaver. I think where we are now, our growth, although we are returning back to growth, the retail's balance sheet is smaller than Weaver, and the retail standalone balance sheet we generate cash, and that cash that we generate is sufficient to fund our store expansion, and we use a little bit of funding, to also kind of fund those showrooms, and it's got a 2-year turnaround, payback period. So, we're quite comfortable with that. The question on the Chinese, it's an important one. We've seen that it's become extremely competitive in the online space, and that's where they're dominating it. And we've kind of, we don't want to get involved in that war. So we are taking our product to our customer, and that's what we're doing. So, you would also see that our online proportion of sales as a percentage, it's reduced a bit, and we are taking our product to our customer where they can feel it and engage it. We go on regular trips. I've been up now to an area called Bushbuck Ridge, up in the north, Nelspruit, Hazyview, that area. There's about 80 kilometers where there are thousands of houses and multiple malls, and our customer wants us to be there. We have the best bedding in South Africa, and we believe by taking the product to her, that's the right strategy. And we believe we can probably get to, 100 is the short-term target, but the market is big enough for 150 plus, we believe.
Yeah, thanks, Chris. I just follow up on that. I was going to say, one of my questions was, what do you think the total retail footprint for your offering could be? But a follow on to that, the 20 to 25 stores annually, is that kind of a good cadence we should expect if we look over the next 2 or 3 years in terms of rollout of those retail offerings?
Yes, that would be like the minimum we want to go after. It depends on sites and getting into those malls. So that would be our minimum ambition. We do believe that there's opportunity for us, to at least 250. So as we prove the concept, I think we're comfortable, to go on that. And also, the thing about these malls that are close to where our customers stay, it's a massive social impact also for us. All the guys working in our stores come from those areas. Our customers don't have to drive long to collect the goods. It's a real big social impact also that we're making.
Speaking of social impact and demographics, and by the way, I love how clear you are in your customer avatar. It's very refreshing to see that. There's a question here around what LSM your customer typically falls into. I'm not sure if that was in the deck. I'm sorry if I missed it, but the question is here as well. So even if I missed it, someone else did as well. Is it a similar customer to Lewis, for example? Where do you guys kind of see yourselves in the LSM journey?
So we wouldn't really look at LSM. Our customer is a urban African woman, the majority. She earns about 10,000 rand on average. She's got a family. Her average age, she's about 40 years old, and she cares for her family. Data analytics, one of the questions we're marketing. So we take millions and millions sets of data, and we model things, and we determine certain personas, and those are the type of personas then we go after. Sean's business, he'll speak about, it's a little bit more affluent, certainly in the PayJustNow space, but ours is that mass middle market urban lady that looks for convenience, and really it's quite an aspirational thing for them to also have something in the house, in their homes, linked to Homechoice.
Yeah, just following on, Chris. So the financial services customer was traditionally born exclusively from the Homechoice customer. So our heritage in financial services is what back in the day was LSM sort of 4 to 8. But we really don't use that concept. I haven't heard LSM for a few years now in terms of the way we engage with each other when we're talking about the customer. It's, she's earning sort of 5,000 or 6,000 rand up to 25,000 rand on average, about 16,500 rand in the financial services business. The PayJustNow customer tends to span all financial tiers in the marketplace. For example, I use it regularly. It's a no-brainer way to shop. I'm not in the market though for personal loans and what have you. But our customer base in financial services is quite broad. But the sweet spot is the lower middle income mass market, earning sort of between 10 and 20,000 rand a month, where there is a need and a demand for convenient credit.
Sean, just given we tend to have a lot of retail investors on here, just could you briefly touch on dividend policy? I know you guys declared a dividend with this result, but maybe just what the overall policy is today. Go ahead.
Yeah, we don't give guidance on it as such, but we do have typically in the past, and looking historically, we pay dividends twice a year, and we at two times cover. So, and we've done that consistently now since the lockdown ended, and prior to that, we were also pretty regular with our dividends. we've only not paid dividends as far as I can recall in a number of years when we held back during the uncertainty of lockdown.
Okay, thank you.
I've got an important question in my DMs, and it's very important as well for me, and that is just around liquidity in your shareholder base. So obviously here you are on Unlock the Stock telling the story. So I think there's obviously a keenness to get more investors on board. I mean, my personal view, which isn't really something you can comment on, I think the multiple you're trading at the moment has a massive liquidity discount in it versus the underlying growth you're achieving. That's certainly key to my investment thesis, I'll be honest with you, is a multiple uplift. So for me and for the person who asked in my DMs, how do you see the liquidity in the shareholder register progressing? I mean, is there an option to just make it more liquid? It's very, very tightly held, obviously, at the moment.
Yeah, you're right. It is tightly held. I think the last I saw on the share register, about 4.7% of the share is free float. A few percent held by management, and there are two big anchor shareholders owning 70 and 22%. And obviously they're acutely aware of the liquidity. So we're looking at options to increase liquidity. And I can't give you any heads up there, I'm afraid, Finance Ghost. But we are aware of the discount to where the PE would be if it were more liquid, and management is looking at what we can do about that.
I kind of expected an answer along those lines, but I thought I'd ask.
Yeah, no. I mean, to be frank, we're just focused on growing a great business and then becoming, increasingly attractive. And obviously there's a number of options for what we could do to generate returns for the shareholder.
Yeah, I mentioned it to go staff line there. An underwritten DRP could be something you could look at. I've seen that work for a few micro caps and small caps in Australia to great effect. But speaking of growth, we might end off on this question. Kind of 5-year outlook. The question revolves around, is it just doubling down on the fintech side and expansion on the retail side, as Chris has alluded to, or is it, expanding the product offering, whether it's on the retail or the fintech side, or potentially, even a bit of M&A to, get you into, another vertical you think where, we don't have a big presence in this market, but actually our product set could work very well, once we kind of have a customer base to kind of launch off.
Yeah, so I'll speak to the Weaver side. So we have a growing product set in the payment space, the pay in 3, the pay in 12, and you can extend the terms and give customers more options at the till. On the insurance side, we've got the 2 life policies, a personal accident and funeral, well understood, and we've got lots of growth there. And then short-term insurance in the payments funnel. So, for example, offering customers a short-term product that befits what they've just purchased using the payments network. We see that as an opportunity to grow and have depth and breadth in insurance. And then fee-based income coming from the business-to-business side. So merchants are increasingly paying a lot of money now to Google to be rated against Temu, for example, and we see our platform as being very attractive for merchants to advertise on and generate trade back into their stores and their online businesses. So again, that we see as a growth vector in terms of being able to generate additional fee income into the portfolio. And it remains that we could acquire another startup that's in a different vertical within financial services. But at the moment, there are no short-term plans there, but it remains something that if something interesting comes across the table, we will certainly look at it. And Chris, do you want to close on what you on the?
Yeah, maybe just on our side, our ambition certainly is to open up the jaws on the margin. We're out of our turnaround and we're in a growth phase, so you can see the operating leverage and the margin will increase and that will grow. And that's something that for the next 2-3 years, that is the absolute key for us.
Vanessa, let me have one more. Let me have one more. I've got one last one. I see you coming on there waiting to like clamp down on us. So, and again, I'm sorry, this is just because I need to ask because I'm really interested. So there's someone in the DMs who said, it is inevitable that the Chinese brands will someday become physical in South Africa. Look, inevitable is a strong word. We don't know that for sure. I guess that risk is always there. I think there must be other risks that are keeping you up at night at the moment. And I would like to ask you for what the biggest one is. What is the one thing keeping you up at night? If I open my share portfolio a year from now and I regret this day, what do you think it would have been that would have hurt you?
Well, maybe if I can just, quickly just answer that, the Chinese question. What we have 40 years of data, and we're going back to that. We use data, and we use data to kind of pinpoint where the store comes, where the footfall is. We are 90% plus credit, and our secret sauce is combining the merchandise product, the credit, and that in that kind of triangle. And that's kind of been our secret sauce. And if the Chinese come with that, we have an amazing product, and our product is superior. So we're very, very comfortable to have that competition. And we've taken market share the last year, and we're confident we'll do that in the next 2-3 years. I think for us, and maybe this is it's kind of a wrong view to take. We don't believe in things like recessions or the market is tough. The market is tough for everybody, and we have to make sure that we are better than others, better than some of the competitors, and make sure that we can kind of execute in that space. So probably the biggest risk is in our expansion is to kind of keep up with that in terms of systems and people.
Sean, I won't let you off that easily. Give us that one risk. I see this awkward silence here.
No, I'll talk to the Weaver side. So Weaver's biggest risk for me, there's a couple of them. We are growing at CAGRs of over 30%. That means, we're doubling the size of the business every couple of years. And with growth comes, the teething problems of dealing with things and trying to forecast the future and recruit ahead of the curve and have tech ahead of the curve and make sure that you're keeping everything compliant because there's lots of moving parts. And so it's about just holding on and managing the growth. And that for me is key. And because it's a credit business, we're trying to shift towards more fee-based income to balance out the risk of credit with getting and the risk of funding on credit with getting cash in on the fee side. And then your credit risk, compliance risk, funding risk, these remain risks that we've been dealing with for frankly for 18 years in the FinChoice business, and it's something that I think we do well. Managing risk is something you need to be eyes wide open and be a little bit paranoid to remain competitive and in the game. And my team and I are continually paranoid. We don't rest on our laurels or think it's been done and dusted and move on. It's a constant game of interrogating credit with marketing, looking at our risk appetite, our funding, and then balancing our scorecards against what we're seeing come through in the market. We're constantly adjusting our scorecards based on a great scorecard next month can start looking bad business because one of your competitors tightened and you got all of their customers that they didn't approve. And so suddenly what you thought was working well doesn't. But we're so nimble in terms of being able to see the roll rates go up and then tighten and move forward and trade through these times. And we've proven it many times over the last several years, which is, of course, why our consortium of bankers and other lenders, like what we're doing.
Yeah, with great growth comes great responsibility, hey? The Spider-Man FinTech edition. Anyway, Vanessa, I will shut up now and hand back to you.
Thanks, everyone. That was a really awesome discussion. So thanks to everyone who chose to spend time with us on this session today, and a special thank you to Chris and Sean. It really was a great discussion, and thank you for making the time to support this retail investor platform and to engage with the investors. We hope that everyone on the call has enjoyed the session, And if you would like to listen to it again, it'll be available on the Unlock the Stock YouTube channel soon. And we encourage you to subscribe to the channel and have a look at the latest videos. Our next session of Unlock the Stock will be on Thursday, the 20th of March, and that will feature another new company to Unlock the Stock, which is Fortress REIT. And then that is all from my side. Again, Sean, Chris, thank you very, very much, and goodbye to everyone.